It's incredible to look at.
We're going to start this week with some 4-year-old footage provided by the BBC, shot just before COVID, March 2020 hit the fan. These images from within the bowels of the seemingly lawless city of London's underoos, if you will, juxtaposed by the ongoing trends in the world regarding gold. The trend is simple. Get your nation's hard gold bullion savings the hell out of that place. Yes, the oldest full fiat currency issuing central bank of the world, you're looking inside their gold vault. Allegedly around 5,000 metric tons of gold are stored there, mostly for other sovereign nations, in their basement, built on slippery, shape-shifting clay. You might recall in 2019, Poland pulling 100 metric tons of their gold from there, shipping it back home to their Polish central bank. Or in 2018, Venezuela's Hugo Chavez getting told by the Brit Anglo powers that be there, no gold for you, the last time he asked for some of his country's gold back for repatriation. Well, and probably the biggest gold-related news this week was India, having just pulled 100 metric tons of her gold back from their long-time Bank of England held stash. Perhaps a bit more speculation or forward-looking whys in a few minutes on that front. But first, I want you to understand the size of this bullion withdrawal by India, at once colonized by the fated British Empire nation. This is one of the lame pictures the Bank of England allows out in the public domain to show off her gold basement. Cool, huh? Well, India just took that whole rack of 25 columns back home. Back to the footage a month before COVID hit, 2020.
What would this be worth, roughly?
£475,000.
I'm sorry, come again?
£475,000 at today's market price.
Interesting, because in late 2019, the Fiat Bank of England, Fiat Federal Reserve, the Fiat Bank of Japan, and the Fiat Central Bank, along with BlackRock and other wannabe masters of the universe minions, all unilaterally decided it was time to, quote, go direct and flood their respective fiat monetary systems with massive injections of fiat M1 currency supply issuances. Yeah, a half year before the pandemic even hit in earnest. Not surprisingly, gold has nearly doubled in spot price since, in all 4 locations. Say it one more time, Pudgy.
£475,000.
Not today, it's not.
So most bars are in this, what we think of as a trapezoid form. Mm-hmm. It makes it easier to handle. But this bar here from the United States is in the form of a brick. The Federal Reserve Bank of New York, it is built on bedrock, so the gold can be stacked one on top of another.
He's not lying. You see, the fated British Empire's Bank of England built their gold vault on clay, which can't withstand the weight of more than 4 tons of gold stacked on top of one another. The Fiat Federal Reserve of New York, on the other hand, is sitting on bedrock, and it still allegedly has, though Germans might disagree, the largest reported hoard of sovereign gold collectively stacked in the world in one place. More on the New York Fed's failed fiat propaganda regarding gold from this week in a few minutes, but back to England. Explain it away, sir.
Here at the Bank of England, because it's built on clay, we have floor loading limits, which is why we have the gold in pallets.
The Bank of England likes to brag they've never had their gold or others' gold stolen from their basement.
Ever since the bank was founded in 1694, no one has ever stolen the gold.
But I looked this up. The story's old, but it's very real given construction work in London around those streets at the time. In 1836, the directors of the Bank of England received an anonymous letter in which the author claimed to have direct access to the gold in the bank. The directors assumed this to be a joke and simply ignored it. However, sometime later, they received another letter in which the enigmatic author offered to meet them at an hour of their choosing inside the main gold vault. The directors were intrigued, but considered it impossible for someone to break into the vault without their knowledge. Nevertheless, they agreed to the meeting and gathered together one evening inside the vault as agreed. To their great surprise, at the appointed time, a noise was heard beneath the floors, and a man popped up underneath their feet. He was a sewer worker who had been working on repairs close to the Bank of England site at the Threadneedle Street. During his routine inspection, he had discovered an old drain that led directly underneath the gold vault inside the bank itself. After a quick stock take, they realized that the sewer worker had not taken anything from the vault, despite having multiple opportunities to do so. As a reward for his honesty, the directors gifted him £800, a sum that equates to, let me do the math here, £800 in 1837 at the time was just over 188 troy ounces of gold bullion. or just under 500,000 in fiat US dollar equivalents today. Well, some of us might feel the honest sewer worker got stiffed considering his easy solo access to the supposedly impenetrable front of a highly secure gold vault. At least he got to keep his dignity and sleep better through his remaining nights in this plane of existence. Onwards to why India is now repatriating gold from London in such size. I'm sure all the BRICS followers out there have their own pet theories as to perhaps why. Here's perhaps one for me. Is it possible that some of the nations leading the coming BIS Inbridge wholesale CBDC sovereign capital account payment system might be considering using gold as the ultimate payment settlement beyond mere digital currencies from time to time? The Financial Times this week reminded readers that the coming wholesale CBDC grids will likely lead to more passive fiat US dollar diversification over time, as more and more central bankers put less and less of their future reserves into Western fiat currency units, and perhaps more and more into building out their respective economies or into their collective gold piles. Well, that might be disruptive. But think about it. If these massive BRICS nations can trade bilaterally directly and seemingly with less or no fiat US dollars as the trade intermediary, that would be bad for demand and overall buying power of said fiat US dollars to come. No? Cut to the Fiat New York Fed's website this week, which pounded the table, basically saying the shrinking dollar demand story is overhyped. And while that may be true for now, technology oncoming that they didn't dare to discuss in this article will quickly change that. The authors categorized China, India, Russia, and Turkey as a small group of countries in their writing. The internet raged. They forgot to mention that between the four powerful BRICS nations mentioned, they collectively own about a fourth of all recorded gold ever mined already. They also forgot to mention that over a third of the human population resides in those four countries, in regions that stand to get increasingly wealthier and more powerful as time proceeds. They did stick their dumbed-down chart in here. Certainly it misdirected some of their readers to think, yeah, official gold buying, while it may be at record highs the last years and a quarter, look at how tiny it is in comparison to all the fiat promise piles the central banks collectively own. Well, massive bear markets in bonds have begun post-COVID 2020, and major fiat currency bear markets, thanks to oncoming CBDC disintermediations, are likely one of the next major planks to fall. Oh, and the official gold reserves, they collectively just passed the fiat euro as the second largest collective holding by world central banks combined. So, the fiat US dollar is the final major boss for gold to pass in the years and decades unfolding. Turning now to the political and judicial drama this week in the United States. And while I try to remain apolitical here and not get too deep into the weeds there, it's virtually impossible to analyze gold and silver markets without doing so from time to time. And seeing my home country being culturally and politically divided/conquered consistently, that's never fun. But being an alleged doomer, supposed loser silver bull, when I saw the shorts paint back the $31.80 an ounce rally yesterday, my heart sank. Just knowing the inevitable end-of-month retest at $30 an ounce would paint the tape today, of course. So I woke up to this clip, making a bit of a silver lining in the lunacy of this world we're living in. Hopefully you find it funny as well. I'll be back after this break shortly.
Are you worried about going to jail?
This was a flim-flam sham. This was a rigged trial with a pro-manipulation judge who hates silver. It's a rigged market, a disgrace. They want silver's price low, I want it huge. The WEF can't handle silver. To go to moon, and beyond that, into the unknown. China is making America into a bunch of silver fools. Real information from the apes will help make silver in America great. And they know what happened here. Everyone knows it's about silver.
Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates.
And be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
Make some room in your safe because a whole lot of silver could be coming your way. SD Bullion's Monster Box Sweepstakes is back, featuring 500 of SD Bullion's very own Silver Tree of Life coins in a monster box for the first time ever. This stunning silver coin is a highly detailed masterpiece featuring a hidden inscription on one of the tree branches that changes every year. So put on your best flannel and become one with the forest, and take your shot to win 500 silver trees from SD Bullion, because someone's gonna win it, so why not you? Click the link below for your chance to win.
Not surprisingly, it was an up and down holiday shortened week in gold and silver price action, with the first few days of derivative-driven price discovery being dominated by levered Asian trading, only to let the COMEX shorts paint the tapes lower to close this week and the month. The spot gold price finished at $2,330 an ounce bid, and the spot silver price stayed strong to importantly close the month with the spot price taped above 30 an ounce. And that's important because monthly price breakout watchers are out there in hyper-levered derivative markets looking for places to bet. The spot gold-silver ratio finished the week down and then up, basically flat at 76. For those looking to buy the spot price dip in silver, look no further than this proper low-premium sale on pre-1964 US 90% silver coinage at SD Bullion. We're certainly not minting any more of them anytime soon in the United States, and much of them have been lost to industrial meltage over the past 60 years. And from time to time, their price above silver spot premiums blow sky high, reaching nearly 50% above silver spot prices during both the 2008 global financial crisis and more recently in late 2022. If you don't think this will happen again, I got a bridge to sell you instead. Interesting bullish mainstream financial articles on exploding silver industrial demand this week, most of them dealing with the combination of China silver bullion premiums, record Indian silver demand through April 2024, solar panel productions, and increasing silver electrification demands worldwide. Bloomberg has the peak of silver importation premiums paid in China as high as plus 15%. Now my charts have been saying 12%, but whatever. The point is, China has been increasingly buying silver by nearly an additional 100 metric tons per month of late, paying through the eye to get it, often from the dwindling City of London unsecured silver ETF coffers. The story on silver through this recent breakout has been all about industrial demand, really. So let's hear from TD Securities senior commodity strategist Daniel Gali speaking to this week to Canadian Bloomberg on that phenomenon.
All right, we've talked a lot about the recent rally in gold. We've talked about the rally in copper, but check out what's been going on with silver and a huge recent move, something that our next guest saw coming. Daniel Gali is a senior commodity strategist with TD Securities, and he joins us here in studio. Nice to see you.
Thank you very much. Thanks for having me.
We talk about some of the dynamics that are moving some of those other metals. What's been going on in the silver market?
Well, listen, I think that silver is probably the most exciting trade in the energy transition theme within the commodities complex today. What we're talking about here is a market that has been in a universally recognized structural deficit that most analysts across the world predict will continue to be in that structural deficit, which is essentially driven by the boom in solar capacity across the world and the growing trend of electronics being embedded in really everything that we do, but particularly so in vehicles.
So the deficit meaning that there's just not enough silver to go around for some of these demand needs in different components and that kind of stuff?
Yeah, exactly. I mean, a lot of ink has been spilled on the story for copper, right? We just went through a decade-long bear market, as a result of which there has been a structural underinvestment into mining and metals capacity across the world. And silver is primarily mined as a byproduct of lead and zinc mines, of copper mines, and of gold mines. So there are very few companies that mine silver specifically, and as a result of that, the structural underinvestment into the mining space has resulted in this structural undersupply of silver that we're seeing today.
Interesting. And so ultimately, what do you when did you first start noticing the trend? Because you've been pretty constructive for a while now here on silver.
Yeah, absolutely. We've been constructive. There's a lot of pieces to the puzzle, right? In this case, this is a situation where we've been in a structural deficit. Most of the time, it doesn't matter in silver markets. And it doesn't matter because the world is sitting on a massive amount of above ground inventories that can be relied on to satisfy the gap in physical market balances. The difference today is that we think that assumption is going to be challenged in the next 12 to 24 months. We think global inventories are probably overstated when you account for the amount of silver that is actually freely available for purchase. And as a result of that, we're probably in a situation that could lead to some pretty extreme price action in silver.
And is this something that continues, in your opinion, over the long term? Because I think when a lot of people talk about the copper boom right now, they're painting a picture over the next decade based on some of those larger demands that people are talking about.
Well, demand for silver is probably going to boom for the foreseeable future. But we do think that a lot of the technologies that underscore solar capacity, for example, are going to thrift out the silver content over time. So this is more a story over the next year or two, where you can see a temporary squeeze on prices that could relate to substantial gains in prices.
They would just make changes to the equipment components that would mean less silver required for them, almost to like just control their own costs, or?
Yeah, to control their own costs and to ensure the production chain or the supply chain for solar panels and electric vehicles and so on.
Can keep going because you don't want to be beholden to a market where there's only limited supply of a product or higher prices. So a lot of moving parts there. Why do you think this is a lesser talked about story in a very busy market where everybody's busy talking about everything right now? Why do you think people haven't talked as much about silver?
Well, partly because over the last decade, it didn't really matter what supply-demand balances meant, right? That was a decade that was characterized by financial flows dictating the silver price and gold price by many extent. But what we've seen really since the pandemic, and increasingly so over the last few years, has been a trend that physical flows in precious metals have been larger than financial flows. What that really translates to is this theme of central banks accumulating gold, of renewable energy and the electrification of our economy demanding a lot more of these metals.
And so, Daniel, like the stock market rally we've seen in Canada this year, in part through the material sector, has also in part been because there's been some silver-related plays that have caught the attention now of investors. But when you're talking with clients about ways by which to play the silver boom, how should people think about investing in silver, in your opinion?
Well, there's a variety of ways of investing in it, right? As a commodity strategist, I really do a deep dive on the commodity side of the equation. So there's multiple derivatives that are available. There are, ETFs that are available, and so on as well.
Okay, but we've had a pretty big move. So just which you had some expectations we'd see a notable swing to the upside. What's your general take on where silver prices go from here? Maybe give us your roadmap from here.
Yeah, what's interesting about the recent run in prices is that it still doesn't appear to be discounting this kind of view, that the inventory picture is going to be really challenging over the next year, that you could see a squeeze from the physical market drive prices higher. It's instead been related by a huge influx of capital into the commodities complex, and silver, being a smaller market, has adjusted in price to reflect that capital inflow.
While this all sounds bullish silver, and yes, there have been many years thus far in the 21st century where silver spot prices in fiat US dollar terms have popped nearly plus 50% to plus 80% in January through December timeframes, the analysts didn't bother to explain how ridiculous silver spot price discovery around the world has bifurcated, especially since COVID 2020. The current shadow Eastern aggregated silver price from 1970 until I last looked this week in late May 2024, that's ballooned to over $386 an ounce. And while silver bulls out there are creating charts illustrating respective silver price breakouts of the past, denominated in today's fiat US dollar terms, I simply want to remind you that if we go off the questionable data of either industry analyst firms, the often hated CPM Group or the often hated Silver Institute, both data sets provide similar hardening pictures in the silver market. Silver industrial demand is exploding, supply is not keeping up, 4 years of deficits and counting. Silver bullion investment demand is the wild card that can both exacerbate the currently tight industrial 1,000-ounce bar situation and will likely lead again to shortages and premium blowouts in the retail, wholesale, silver, and gold bullion markets again to come. Any week now, another U.S. digital bank run fiasco could kick off. Regional bank shares are trading like hot potato trash, and Fiat Federal Reserve is now admittingly sitting on an unrealized $1 trillion in losses, with the garbage bond portfolio has been forced to buy. Interest on our exploding hard U.S. debt levels has just passed our bloated military spending. And the uber wealthy are mostly asleep at the wheel, collectively allocated to precious metals to the tune of 1% in the aggregate. Be it silver or gold, my strong suggestion is to get properly positioned sooner rather than too later. Indian demand, Chinese demand, Middle and Far Eastern demands, they're not going away, and the West has yet to experience the coming store value crisis that is building up while they remain distracted and confused within illusory, overpriced bubble markets. Let's hear a proper British bank analyst talk about $3,000 ounce gold within the next 12 months. Have a listen to how nervous he is admitting the building bullish gold facts.
Is quite out of consensus in terms of City Research's house view. We've got 5 Fed cuts this year, lower real rates into the end of the year, early next year, and that's certainly going to be, we think, the backbone of the next move higher in gold, right? So gold's probably the one that we think is most leveraged to that out of consensus view. We've got it going to $3,000 over the next 12 months.
So
oil lower, gold higher.
5 cuts and the market is only pricing in 1 right now. Where does that leave gold? And I was going to come on to talk to you about gold prices.
Yeah, I mean, it certainly would make us less bullish, but I mean, the underlying drivers of gold are very physical at the moment, so we feel like there's support for these gold prices. Obviously, gold's broken the relationship with real rates of late, and that's been all about colossal Chinese retail demand. I mean, off the charts. And China's, like, in my career, I've never seen China on the bid at the highs. And the dollar notional that they're putting into gold is, we ballparked it, it's roughly 40 to 50% of what would have otherwise gone into property. It's a big shift from property spending into gold in retail in China. It mopped up about 2/3 of ex-China mine supply in the last 3-4 months. So, really absorbing all the mine supply, that plus the central bank demand, and there's nothing left for the jewelry market.
And just I know Christy's coming in, but does that change, that dynamic in China around gold? Does that change? Do you see anything that changes that?
Yeah, I mean, that is the biggest downside risk to gold for us, is that ultimately the government controls the quotas on the imports, and I mean, the imports aren't necessarily, their quotas aren't published, and they could dry up if the government becomes unhappy with the transfer of wealth from perhaps consumption and retail into physical gold.
So what's the way to invest in gold then right now? If I'm an investor looking at gold as potentially that central bank hedge or whatever your bull case might be, do you do it with the physical demand? Do you call your folks in Asia and say, let's stock up, or do you do it via the liquid ETF markets of the States? How do you access it? How do you get to it?
Sure. I mean, there's equities, ETF, the commodity.
Sure, but what's the most lucrative
Yeah, I mean, CFTC, I always worry about getting these questions because I can only answer on the commodity side. I'm not allowed to give a call on equities. Certainly not allowed to talk about ETFs. But look, on the commodity side, we've got, I would say overall the action in commodities has been almost 95 to 99% copper from a client activity perspective, from what I hear about and I see. It's not so much been in gold. I think there's a lot of room for gold. I mean, frankly, many people, including ourselves, were scratching our heads as to what the new drivers were, and now they've become clear that it's China. I think we're going to get a lot more interest in gold because people can kind of get their heads around it.
Finally, to close this week, I want to take you back to the summer of July 2017, just about 7 years ago, back when the still CEO and chairman of the CME Group, Comex NYMEX, basically admitted on air that precious metals are going to mania phase at some point. See if his points don't jive with what you are witnessing in this often too short-sighted world we are currently living in.
Look at back in the early 80s, it was trading around $800 an ounce. So if you adjust for inflation, you should have gold somewhere around $2,000 to $3,000 an ounce, but we don't. And then you look at what's gone on in the world, and it should probably be at $5,000 or $6,000 an ounce, but it's not. So the reason is, I think a lot of us have become so jaded, and whatever happens in the world, it's like yesterday's newspaper in 5 minutes. So people are dismissing some of these events to a point where one day you won't be able to dismiss them, and you'll see a huge move in some of these precious metals and other products.
I know you and I are sounding like the Cocoon Club here, but I think a lot of young investors, they don't remember that a lot of this stuff that historically we have, resisted of late, but you haven't resisted, the simple fact that markets do go up and they do adjust and they obviously do change.
And so, my fellow Cocoon Club members out there, that's going to be all for our weekly SD Bullion Market update. And always to you out there, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.